Welcome back to Hedgeye TV. I'm Energy Sector Head Alec Richards. I'm joined today by our friend Stefan Wieler from Goldmoney. Stefan is a Director and Vice President at Canadian-listed Goldmoney. First off, Stefan, thanks for joining us today. We're going to talk all things crude oil. Where are you calling in from today?
Yeah, thanks for having me. I'm calling in from Zurich, Switzerland today.
Awesome. I can imagine that's a little bit nicer than Stanford, but just barely. So, Stefan, why don't you start by giving us a brief background on who you are for people who haven't seen you before on Hedgeye TV, and then give us a little bit of a background on your firm, and then we can get into the crude oil report that you published about 2 weeks ago. Yeah,
so I'm a Director and Vice President at Goldmoney. We are a precious metal custodian. I'm publishing research report on many macro themes, but macro and commodity, with probably a focus on precious metals and energy. My background is clearly energy. I've been an energy analyst for over 10 years. I worked at Goldman Sachs as the senior oil analyst, and for a while at a energy-focused hedge fund. So I'm basically bringing the energy side to our research product we have at Goldmoney.
Awesome, awesome. Well, thank you for that, and we'll get right into it here. I mentioned earlier that you put out a report on crude, and I think along with this episode, we'll post your report so people can take a look at it and supplement what we talk about today. But I think the right place to start for us is just a brief overview of your thoughts and your thesis that you outlined in the paper, maybe a 2-minute elevator pitch, in case people don't want to spend the full 30 minutes or 45 minutes with us, that we go into some of the more nitty-gritty details.
Yeah, so I mean, most people have noticed at this point that oil prices or oil spot prices were basically rising for about 2 years. What we focus in this report is actually on longer dated prices, which until very, very recently, basically until the day we put the report out, have been trading in a very narrow band of around $55 to $60. So while spot prices have gone up about 100% from the bottom, the back end has barely moved. And so what our thesis is that this probably, the next big move in oil prices probably comes from the back end. And the reason being that we have this massive forward imbalance between demand continuing to grow, but we don't really have many projects anymore that will come online. And so non-OPEC ex the U.S. shale production will be pretty much flat and then start to decline in a couple of years. And so the whole burden of bringing on new supply to meet forward demand, it lies right now on U.S. shale producers. And we just don't think that they can actually meet that in a couple of years from now.
Awesome. And just as a clarification for people who are listening and don't have the same familiarity that we might have, the current environment that we're talking about is backwardation, where the strip prices are ahead of forward prices, and then the inverse of that would be contango, just to define a few of the terms that we might be talking about today. So, you mentioned shale. Obviously, that was the result of the last underinvestment cycle. Can you talk about one of the things from your paper was just the idea of excess OPEC capacity, where OPEC cuts were well below where capacity actually was, or nameplate capacity. I think today we're much closer to that nameplate capacity, or actual capacity, if you want to call it that. So what type of supply could OPEC re-inject into the market today if it wanted to turn on the spigot 100%?
I would say nameplate capacity was pretty much where they were just before they started enforcing the cut.
Okay.
Obviously, this is a fluid kind of target, right? So if you had asked them to produce more overnight, they probably couldn't bring on that much more. But if you had asked them to produce more over 6 months, I think the core OPEC producers could make pretty aggressive investments in some of their existing fields and would be able to squeeze out a little bit more. So it's not that this is not like a total hard cap, and there's probably a little bit more available if absolutely needed.
Right.
But for substantially more production, even core OPEC producers would actually have to invest in projects that would take years to come online.
Okay, so I guess the way to summarize that is where OPEC is today. It would need additional supply if demand were to increase significantly over the near term. And then, I think you add to the equation a few of the hotspot areas that you highlighted in your report and that are in the news flow today. One is Venezuela, obviously possible sanctions there with the recent election, and production has just fallen off of a cliff. You have pending sanctions in Iran, which could mitigate up near 1 million barrels a day if you went back to kind of where it was pre the nuclear deal. And then I think a couple of the other areas that you called out were Kuwait and Libya. So maybe just talk about the risk to actual OPEC supply from some of the impending geopolitical risk.
Yeah, no, I'm happy to. So, well, obviously OPEC did enforce some cuts in late 2016, and those cuts came mainly from Saudi Arabia and the other core OPEC producers. So that production now is spare capacity, and that's what they're basically talking about bringing back. Now, what we highlight in the report is that they have to bring back the production anyway, because OPEC is not producing, or OPEC as a whole is not producing at the target they have been setting themselves, and mainly because production from some core OPEC member started to decline quite rapidly. The main focus there is on Venezuela, which even without sanction, we actually saw that production has been declining quite rapidly, and the latest data shows that this decline has continued. So they were down close to 500,000 barrels a day over the last 6 months, and this probably has accelerated to over 600, probably 700,000 barrels a day year over year over the last month or two. Just in order to bring back production where it was, OPEC has to increase its output, or other OPEC members have to increase their output. That doesn't include Iran, obviously. That is another potential loss. Obviously, the sanctions are the whole setup of the sanctions are different, and we don't know whether they're going to be enforced. So the sanctions would only come into effect in November this year. However, the current administration has already advised potential buyers of Iranian crude to basically show good faith. So to reduce some of their imports now in order to receive waivers down the road. So maybe I have to take a step back there. So last time we had the global sanction against Iran under the Obama administration. The way this worked is that some buyers of crude could continue to import Iranian crude oil, for instance, Indian refiners. However, they had to reduce their imports in order to show good faith to the United States and the other nations that imposed the sanctions in order to obtain waivers to do so. And they have to do this now to obtain waivers later down the road. So to obtain a waiver by November, you have to reduce your imports somewhat to show that you are on board with all of this. Now, obviously, during the last sanctions, it was a broad coalition of countries that imposed them. So it was not just the United States, but the European Union was on board as well. And this time, it seems that the United States is more alone in this, and some European countries are posing actually further sanctions. However, given the nature of these sanctions and how they can be imposed, so that it's not just that countries or companies that would violate the sanctions would face sanctions of their own if they operate in the United States, but also these countries basically rely on banks that have to handle the payments. They rely on tankers that move the oil, for instance. They need insurance, etc., etc. So there is a way for the United States to impose sanctions even if other countries are not on board with this. And I think we are going to see the impact of this already now over the next couple of months, even though the sanctions don't really take effect until November.
Awesome. Yeah, no, that makes sense. Maybe we should start calling you Stefan Nostradamus, because you did mention earlier that you thought that OPEC would need to add additional supply to offset some of the capacity constraints at some of the member countries. You mentioned Venezuela, and then obviously we got into Iran earlier. And that looks like exactly what they're going to do based on some commentary they made on Friday. That was from Saudi Arabia and Russia, talking about adding production just to hit their current targets. And if we switch from OPEC to just really the supply side of it, one of the things that we probably need to go into a little bit more is just where future supply is going to come from. And so I think, and you mentioned it earlier, U.S. being a swing producer, but I think in your report, one of the issues that you raised is that the U.S. hasn't shown that it can be that swing producer going forward. And if you look outside of U.S. shale and OPEC, conventional is actually starting to decline, and it's going to be tough for U.S. shale to offset that decline. So one, am I summarizing your point correctly? And then two, maybe give a little bit better overview of exactly what you see coming from U.S. shale and its ability to offset production declines elsewhere.
Yeah, so I mean, right now we still see a little bit of production growth in non-OPEC outside of the shale space. And that production growth is actually from projects that have been sanctioned many, many years ago. Some of those projects actually have been sanctioned even prior to the credit crisis. And that's basically I would say, this is a key characteristic of conventional production in 2018 is that the lead time of these projects is very, very long. Some of these projects take over a decade to materialize. And what we have seen is that after the credit crisis, we have seen massive CapEx spending in the sector, but that CapEx spending was mostly on shale. So especially when prices collapsed, CapEx spending collapsed as well, but obviously kind of like the lion's share again came out of the shale space. But if you look at just the other investment, there's simply not enough investment going into the conventional sector. And we actually see even with the recovery of the oil price, investment in the conventional sector continues to go down. So we see actually some sort of a recovery on the CapEx side in 2018, but that's shale only. Mm-hmm. And so we really don't have enough projects in the pipeline within non-OPEC to counter the decline rates. Arguably, decline rates have been really high over the past year. In 2017, decline rates have really skyrocketed. And that was also because the non-OPEC producers reduced their maintenance spending. And we have seen that actually before. We have seen it in 2009 when non-OPEC producers, Russia was, for instance, a very good example, when their base production actually started to decline much faster than it did before. And I think with the recovery in price, we see some recovery on that as well. But just if you look down the road, we probably can, non-OPEC production probably will grow this year. It probably will grow next year a little bit. And then by 2020, it already becomes quite problematic. So right now we forecast a little bit of growth, less than 100,000 barrels a day in 2020. But this could well be a decline year already. Mm-hmm. And beyond 2020, there's nothing in the pipeline that will come on at that time. So even if you actually start spending right now, there will be a period where you have a gap, where non-OPEC ex-shale production will decline. And so basically the whole burden of growing non-OPEC production lies on U.S. shale production.
Right. And could you talk briefly on what type of future prices would incentivize some of these longer dated projects to get off the ground and up and running? I know it's a very long production cycle there, much longer than U.S. shale, but what type of pricing would we need to see to even start thinking about, offshore development or whatever you want to talk about?
Yeah, so we think probably you would need something around $80, between $80 and $90 to get more projects sanctioned at this point. It's clear that between $55 and $60, this is not cutting it.
I think we're talking here about a supply shortage, lack of conventional, and the question that a lot of people might be asking is, well, why can't U.S. shale offset the balance there? What is it about U.S. shale production that doesn't allow it to fill that gap?
Yeah, no, that's a very good question. So I think in order to answer that if you have that argument with somebody, they will always point to shale gas, and they say, look, if the argument that U.S. shale oil cannot grow and fill in any gap you need, that doesn't work, because we have seen it in natural gas, and that U.S. shale gas has been growing almost unimpeded, and prices cannot recover whatever amount of gas you need. They're going to produce it. So there is a fundamental difference first of all, between shale oil and shale gas, and then there's a fundamental difference between what role U.S. oil plays in the world and what role U.S. gas plays in the world. The difference, simply from a production perspective, is that U.S. shale or shale oil, shale oil, not just U.S. shale oil, but shale oil shows much steeper decline rates than shale gas. Both shale oil and shale gas have high decline rates. But while shale gas, for instance, on average, wells that have been drilled 3 years ago, they're down about 40% in production. Same for oil, it's about 70%. So you need a much faster growing, you need to grow shale oil much faster to offset the declines you have in the base production. So that's number one. And in addition to that, we also have seen that shale oil producers actually have pushed into that direction. So we actually see more initial production and then steeper decline rates, while in shale gas, the opposite has been true. So shale gas have moved away from very high initial production to lower initial production, but then less steep decline rates. So in oil it got worse, in gas it got better. And then the second thing is that you cannot really compare the U.S. gas market with the U.S. oil market. The U.S. oil market is part of the global market. Even before there were, oil exports were allowed, you could always export products. So the U.S. oil market was just part of a global market where oil comes in, products go out, and it's almost free flowing. And at this point, you can say it's basically just one small part of the entire global market. Now, the gas market is much more insulated. The U.S. produces its gas mostly for the domestic market, and it imports relatively little, and it exports almost none. And even with LNG exports, that doesn't really change that all that much, at least not so far. So if you look at actually the U.S. gas market, U.S. gas production hasn't really grown as much as people have thought. Over the past 10 years, it has grown about 3%, and it has never grown like 10% or something in a year. Now, on oil, that's very, very different. If U.S. shale oil production should meet all the demand growth in the world, and not even talking about offsetting declines in non-OPEC production. So if U.S. production has to grow 1.5 million barrels, that means actually U.S. shale oil production has to grow 15 to 20% every single year without any decline. But if you actually take declines into account, then at some point U.S. shale oil production would have to grow like 50% per annum. So we calculated that in about 5 years' time, the incremental supply that has to come online, so the supply from new wells, would have to be larger than all shale production as of today. So it has to be over 5 million barrels just to offset declines and keep on growing at this 1.5 million barrels per day. So that is simply, in our view, not possible, because you're like very soon you're going to bump into all kinds of limits again. You're going to bump into limits with pipelines. You're going to bump into limits with water, fracking sand, export capacity. That's all going to be there. And then you also, I mean, you have to know that what you're seeing right now, this fantastic growth that's coming, that you see right now, that is the result of high grading. So really, because after prices have collapsed and now it's recovering, the shale oil companies have learned and are drilling now the very, very best acreage they have. So if they really have to continue to grow that fast, they have to go back to the acreage they have abandoned or have idled so far, and that's just not going to be the same again. So yeah, we think actually they can grow 1.5 million barrels, which is the highest they've ever grown in a single month. And they would need to grow that for the next 5 years. So we think, yeah, they can do that if the price is right. They can do that maybe this year, and they might be able to do this next year. But then the decline rates are going to be so high that they're going to be struggling to produce at these rates. And they're going to find more and more and more just to keep production constant, and they won't be able to grow that fast anymore. So you really need somebody else to fill in the gap,
right.
Unless you believe that demand just for some reason levels off extremely quickly.
Right. I mean, I think you bring up a lot of really good points there. One of them being just on the infrastructure side of it. And, you know, as we follow these companies, we're just fresh off of 1Q earnings season. And I mean, that seems to be the topic du jour today is capacity constraints, especially in the Permian. And I think one of the interesting things in that is just based on the boom-bust investment cycle. When prices are high, you're pretty much scrambling to build the infrastructure. When prices are low, you're pulling back, preserving capital, and not building that infrastructure to help future growth. So I think, you know, infrastructure constraints are probably worse than they were back in 2015 when we were close to 10 million barrels a day from the U.S. in total, just because there hasn't been investment through the down cycle. And so you're starting to see a lot of that. I guess, you know, I think there's a lot of contention as to what U.S. shale can actually do. I think you highlighted a good point there with just the decline rate associated with that. But I think you have, you know, the EIA saying that they can do 1.5 million barrels a day. And then you have, you know, some of the shale veterans, namely Mark Papa, who used to be at EOG and is now the CEO of, you know, Continental Development. And then you have Harold Hamm at Continental basically saying that the EIA's outlooks are a sham for a lot of the reasons that you cited, being one, high grading of the portfolio, and two, moving from a held by production mode to a development mode. So, you know, how do you square the two of what the EIA might be saying and what some of the industry veterans might be saying?
Well, I mean, to be honest with you, I think if it's really necessary, a lot of the time when you look at the balances from the EIA, for instance, then a lot of times the question is, it's always a question of the price, right? So how much actually supply do you need? Right. And so if the market gives you the right incentive, yeah, I think you can grow 1.5 million barrels a day, but it's going to be painful, and you're going to run into a lot of issues. You're going to see a lot of probably dislocated crude again. So even if you're actually producing it, it might not even be able to go where it has to go. Right. You also have a growing mismatch of crude quality and what U.S. refiners can use, although they have really done a tremendous job, I have to say, over the past 5 years or so to really increase their intake of light sweet crude. But you're going to need to export it, and now on the export side, you're competing with Canadian crude that also has to be exported out of the U.S. So I think physically it's possible. I wouldn't bet against, that's what my former boss said, you never bet against an engineer with enough time and enough money. And if they have enough money, they probably can do it. I just don't think this is feasible to solve the problem over the long run. Right. So, yeah, you probably can make it for the next 2 years, but it's going to be extremely tough to see that kind of growth on a continuous basis.
I think that's a fair point, and we're going to go into wrap it up mode here. I think the general conclusion from your study is that we need to see forward prices appreciate by about 35%, and that's closer to $70 a barrel. So what type of timeline do you expect for that to happen?
Well, the longer it takes, the worse it's going to be. I think it should be now, in my view, and even now is too late, because whatever project you sanction right now is not going to be ready until many years in the future. So it should happen now. We did see a breakout over the past 2 weeks or so. It's coming off a little bit with the crash in the spot price. But yeah, I think actually should be now. Now, I can't say it's happening now. And frankly, the longer it takes, the worse it's going to be in the future and the higher the price has to go. But if we don't do it now, then we're actually going to see a real shortage in the crude market. We're going to see very low inventories at some point, and we're going to see a very backwardated market if that is the case. So if you don't make the investments now, we're going to have to solve it with demand destruction.
Awesome. And then, if we tie this back in, your view on crude versus your particular area of interest, which is precious metals, what do you think this ultimately means for precious metals?
Well, so we just published actually an update or a revised and improved version of our gold price framework, and we basically build on what we found in our first model, which is that you can explain the movements in gold prices with just 3 factors. One is central bank policy, one is central bank net gold purchases, and the third one is longer dated energy prices. And I'm not going to dive into the first 2. We're going to publish actually this report on Hedgeye as well, so I invite everybody to read it. But the longer dated energy prices is really where I think our model differentiates from most models out there, and we think it can really explain a lot in the move in gold prices, which otherwise we can't. And the reason is that energy is such an important part of the cost of gold miners. We find that if you look at the indirect and the direct costs, energy costs gold miner have, that's about 50% of their costs. So that any move in oil prices affects gold mining costs by about half. But what we find is really important is our longer dated prices and not spot prices, because we view gold as money, and gold really, like if you look at the gold forward curve, it is really just a function of lease rates. So the forward gold price should reflect forward energy prices. But the gold spot price, because it's only a function of lease rates, it cannot really deviate from that. So the spot price cannot reflect energy spot prices. What really drives the price of gold up and down are changes in longer dated energy prices. And so if you look at it over the very long run, if you look at, for instance, a barrel of oil priced in gold, you find that 100 years ago, so in 1918, a barrel of oil priced in gold was pretty much the same as it is today. The reason why it is now multiple times so higher is obviously because you had massive inflation in all currencies, so gold prices go up and energy prices go up. But there's a second element to this, and that is really when you have relative energy scarcity, it just becomes more expensive to produce everything. And because gold is gold mining is just like any other mining, it's part of primary industries, it becomes more expensive to produce that money that is called gold. And it becomes harder, or it becomes relatively harder actually to produce it because energy is scarcer. And so actually these moves in energy prices, they work both ways. They're not just working on the way up, they're working on the way down as well. So a large part of what we saw in the decline in gold prices from 2012, from the highs to as low as at the end of 2015, and now back to around $1,300. A lot of this can actually be explained with the move in longer dated energy prices. And so built on that, because we have this positive outlook on longer dated prices, and keep in mind, longer dated prices really haven't done much over the past 2 years. So the move in gold price was more based off the other drivers, which is changes in real interest rate expectations and changes in central bank net gold holdings, but not really on changes in energy prices, even though you saw these massive fluctuations in the spot price. So we think the impact of energy prices on gold, that is yet to come, because the move in longer dated energy prices, that is yet to come.
Awesome. Well, it sounds like we got the topic of our future discussion already lined up. So, Stefan, we really appreciate you taking the time, and I hope everyone enjoys our conversation today. Again, that's Stefan Wieler from Goldmoney, and we look forward to talking again. Take care.
Thank you very much for having me. Thanks.